Overson, there's a few different products out there, mortgage or loan products, some of which are no money down. Would you mind going through maybe the top 5 products that are out there?
Top 5 products that are out there? I think the best loan out there, if you qualify, is a VA loan.
Agree.
Reasons. A, there's no down payment required. Can you put down payment down? Absolutely you can.
Yep.
Do you have to? Nope.
Yep.
And your rate doesn't change or anything like that.
What's the loan limit on VA?
So the loan limit on VA, I believe you can go up to $1.9 million with zero down.
That's just insane.
Well, time to join the Army.
Yep.
I mean, it's mind-boggling.
Right?
Who qualifies for a VA loan, Mike?
So there's a bunch of different qualifications. So if you're active military, there are requirements of how long you need to have been there being active.
Okay.
And it's different if you're National Guard, if you're one of the regular militaries. There's different rules around that, right? So I could literally read off, it'd take like an hour to read off all the guidelines and all those things. Just know it's a little bit different, whether you're active or non-active right now, and then what branch you were in and things like that. But if you're eligible for it, and if you don't know if you're eligible for it, you can contact the local VA office. There's a regional office right here in St. Paul, and they can look that up for you in 2 seconds. Otherwise, if you have a DD-214 and you send that to us, we can actually order what's called a certificate of eligibility for you with that when we have that DD-214, and that says right there if you're eligible or not, and then if you're exempt from paying the funding fee or not, and a bunch of other information on there. So, but I mean, I think the VA loan, like I said, it's a great program. Rates are lower than like a standard conventional on VAs. You don't need any down payment. There's no PMI that you got to pay. So even if you do zero down, no PMI.
That's so huge. The PMI is huge.
Yeah. And so that's why I think it's the best program out there for those reasons.
So if you've got a conventional rate at 5%, what would the VA probably be at? Assuming
probably same like top tier credit scores between the two. You're probably at 4.5, 4.625.
Wow.
And no PMI.
And no PMI.
I mean, like to reiterate, that's huge. That's another $200 you can be putting towards payment.
Yeah.
No PMI means you can get a bigger house, basically.
Yes. Yep.
Absolutely. Yep. Yeah. So I think that's great. The other zero down program that's out there is called the USDA loan. USDA loans are also great too. There's zero down. You can put some money down if you want to, but you don't have to. There is PMI in those loans, but the PMI is pretty cheap. It's only 0.35% annually. The only bad thing about their PMI is that it's payable for the entire life of the loan.
Similar to FHA.
Yep, similar to FHA. So, but zero down rates are good. Rates are a little bit lower than conventionals, typically on USDA, so that's another good thing there. And then the only other caveat to that is that the property itself has to sit in an eligible area. So there is a map that we can pull up that will show eligible areas. So if the house is in that area, it's eligible for the USDA loan. If it's closer to the metro or, around Rochester, around St. Cloud, there's pockets around some of the bigger cities in Minnesota where it would not be eligible, but as long as you're outside of those. So those are the 2 zero down programs. You also have Minnesota Housing. Now it's not a zero down program, but you can get in with as little as $1,000 out of your own pocket. So that's a down payment assistance program that you can use. And it goes across conventional loans, FHA loans, VA loans, USDA loans. You can use basically the down payment assistance across any loan type.
So it's an add-on to like an FHA or conventional loan. Okay.
Yep. And then they just require that you have $1,000 out of your own pocket into the deal.
Okay. And do you have to pay that back?
The down payment assistance, yes, that is a paid back deal. Okay. There's 2 ways to do it. You either make monthly payments to pay it back, or it's called a deferred payment, where you don't make any monthly payments. You basically pay that down payment assistance back when you sell the house, when you refinance the loan on the house, or if you move out and make it an investment property.
Okay. Oh, interesting. Is there an interest rate on that?
Yep. Same interest rate that you pay in your first mortgage. So basically, wherever rates are at on first mortgages, that's what you're going to pay for interest on that second mortgage.
Okay.
If you make the monthly payment deal, if that's the option that that you have to go with, and it's a 10-year term.
Okay.
So it's not a 30-year term; it's a 10-year term. So
what's the AM on it? Amortization.
10-year fixed.
Oh, 10-year fixed.
Yep.
Got it.
Yep, it's a 10-year fixed. So you just have to remember, and typically it's like, well, how do I qualify for the no monthly payment one,
Yep.
you have to be underneath a certain income limit for your family size.
Got it.
If you're over that income limit, you can still get down payment assistance.
Yep.
You just have to make monthly payments to pay that back versus deferring it
Yep.
to when you sell the house or move out of it or
Yep.
refinance a loan.
Okay, got it. Conventional?
Conventional, minimum down 3%.
Conventional, what do people typically do
What do they typically do?
for down payment? 5 or 10 or?
I mean, anywhere between 3 and unlimited amount down, to be honest with you. I mean, I see it all over the board. So in order to do 3% down on conventional, you have to meet one of two things. Either A, you got to be underneath the income limit, or B, you have to be a first-time home buyer.
Okay.
And then you can do 3% down. So even if you're buying house number 10, right? You buy, sell, you buy, sell, you buy, sell, and you're 10 houses into it, you can still do the home ready deal as long as you're underneath that income limit
Got it.
and do as little as 3% down.
Do you know what the income limit is offhand?
For the metro area, it's I believe it's 84,300 to 84,400.
Okay. Combined or for single?
Here's the other caveat too. It's only the income that you need to use for qualifying on the application.
Got it.
So, for example, I make 80,000 a year base. I make 20,000 a year in commissions.
Yep.
Right. If you qualify with just using your $80,000 base, that's all we have to use. And now we're only using 80,000 to qualify. You're underneath the 84.4 income limit. We can do this program for you.
So what if you have a married couple and they're each making 70,000 apiece, but only one of the spouses is buying the property?
Yep.
So then you're good.
Yep. As long as
Okay.
if we're just using $70,000 of income to qualify, and that's all they need, and they qualify based on their debt to income ratio and all that stuff. Yep.
That
Qualify
works.
for the program.
All right. The last main mortgage product would be just the standard FHA.
Yep. FHA 3.5% down. Cool things about FHA is that they allow for a higher debt to income ratio than conventionals. So FHA just has the connotation, for lack of a better word, of that it's there for like lower credit score borrowers and borrowers that are just not as solid as like a quote unquote conventional borrower. It's not the case. The average credit score on FHA last year was like 702.
Really?
Yeah.
That's
right?
really good.
It's surprising, right?
Yeah.
Like you would think, like, oh, okay. So why would someone with a 702 score go with an FHA loan? Well, there's different reasons. FHA has shorter waiting periods after a bankruptcy or foreclosure. So maybe they went through a divorce, or maybe there was a medical event, where a bunch of bills racked up and stuff, and they had to file bankruptcy, right? A one-time event. And so now they're, maybe 3 years out of a bankruptcy, and they got good credit because that's the way they always been. They just had this one-time event that caused that situation. Conventional loans have a 4-year waiting period. They're going to go FHA because they just haven't waited long enough after that bankruptcy.
Yep.
Got good credit, got down payment, got low debt to income ratio. It's just literally a waiting period. FHAs also allow for a higher debt to income ratio. So a lot of times, if you have a house now and you want to buy your next house without selling your current house, an FHA loan might be the way to go on the next house because it'll allow you to have a higher debt to income ratio. So now maybe you qualify to carry 2 payments where the conventional loan, maybe you can't.
Lets you stretch out
Carry
just
the
a
2
little bit
payments.
more, basically.
Right. So there's different reasons and factors as to why someone might go FHA. Just don't always assume it's because they got no money and they got lower credit scores or anything like that. That's definitely not the case.